So we're looking at a market that's, well, it's testing pretty much everyone. So how does a company, especially a real estate giant, manage to not just get by, but actually grow? That's what we're digging into today with Yoma Strategic Holdings. We're going to look at their latest financials to see just how they pulled off some impressive growth in what's, a really tough climate. All right, let's jump in. And really, that's the big question, isn't it? When the economy feels kind of shaky, and you're in a sector like real estate, which can be pretty volatile, where do you even find growth? Well, Yoma's recent performance actually gives us some really interesting clues. It's like a puzzle, and we're going to put the pieces together right now. All right, first up, the big picture. And honestly, it's a pretty powerful story of a financial turnaround. The numbers we're about to see really paint a picture of a company that's finding its footing and building some serious momentum. Okay, let's kick things off with the top line revenue. We're talking about a 19.3% increase. That's huge. It brings their revenue to over 113 million US dollars. And you got to remember, in this kind of economic climate, that is not a small win. It tells you right away that demand for what Yoma is selling is, well, it's really, really strong. But this is where the story gets even more interesting. I mean, growing revenue is one thing, right? But the real question is, are you actually making more money from what you sell? And for Yoma, the answer is a resounding yes. Their core EBITDA, which is basically a great way to measure how profitable their main operations are, it just skyrocketed by nearly 50%. 50! So what does that tell us? It means they're not just selling more stuff, they're actually getting smarter and more efficient at doing it. Now, look, they're not quite profitable just yet, not quite in the black. But you just have to look at the trend here. Their losses have shrunk a lot. They went from a loss of $10.5 million down to $8.7 million. And this isn't random. It's happening because of that awesome revenue growth we just saw, combined with them getting more profitable and, importantly, getting a better handle on their financing costs. You can see they are definitely on the right track here, heading straight for profitability. Okay, so the results are impressive for sure, but why? What's actually driving all this? Let's dig into the engines of growth and see which parts of the business really powered this performance. Time to break it down. And wow, this chart tells a really clear story, doesn't it? Yoma Land is the big one here, no question about it. It's driving a massive 60% of their total revenue. I mean, that's the engine of the whole company right there. But hey, don't sleep on the other parts of the business. You've got food and beverage and mobile financial services, both chipping in a decent amount. So yeah, they've got their hands in a few different pots, but real estate is absolutely in the driver's seat. Okay, but check this out, because this is where it gets really wild. Yoma Land's growing by almost 30%. That's super impressive. But then you look at Yoma Motors. Their revenue grew by an incredible 122.7%. I mean, that's just staggering. Yeah, it's a smaller piece of the pie overall, but when a part of your business explodes like that, it has a huge, huge impact on the whole company. So, what was the secret sauce for Yoma Land? What made it so successful? Well, it wasn't just that the market was good. It was about having the right projects at the right time. People were lining up for developments like Sandaku and Ara. In fact, just Sandaku by itself brought in almost $25 million in sales. It just goes to show you, even when people are being a bit cautious with their money, they will absolutely pay for high-quality real estate. And that crazy 122% jump in the motors division, what's up with that? Well, this is a classic story of pent-up demand. We've seen this happen all over the world with cars, right? For a long time, they just couldn't get enough inventory because of supply chain problems, so they were held back. But now, they've finally been able to restock their vehicles and trucks, and boom, the floodgates just opened. All those people who were waiting to buy are buying now, and Yoma is cashing in. Okay, so the growth story is fantastic, but here's the million-dollar question. Can they keep it up? Is this growth actually sustainable? To figure that out, we've got to pop the hood and look at the company's financial health. Is the balance sheet strong enough to keep this engine running? Let's find out. And wow, the numbers here really do speak for themselves. Their operating cash flow, which, is basically the lifeblood of any company, has more than doubled. It's up to almost $17 million. This is such a critical sign of a healthy business. It means the profits we were talking about before aren't just numbers on a spreadsheet. No, they're turning into cold, hard cash in the bank. And a big reason for that is they're doing a great job collecting payments from their real estate customers. Okay, and this next point is really important. How did they pay for all this growth? Well, if you look at their net gearing, which is just a fancy way of saying how much debt they have compared to their equity, it stayed stable at a really manageable 18.6%. So what's the takeaway here? It means Yoma pulled off all this amazing growth without piling on a bunch of risky new debt. That is smart, sustainable expansion. That's how you do it.
All right, so we've seen a strong performance and a much healthier balance sheet. So what's next? Let's take a look at how the company sees the future and what their game plan is for navigating the road ahead.
So looking forward, it seems like Yoma is playing it smart. They're what you'd call cautiously optimistic. They're not just going to launch a ton of new projects, they're going to be selective. But they do expect people to keep spending, which is a good sign. And here's a really key part of their strategy. They're trying to de-risk their finances. A big piece of that is shifting more of their debt into the local currency. In an emerging market, that is such a smart move because it protects them from all the wild swings you can get with foreign exchange rates. So that really brings us to the big takeaway here. Yoma has shown some incredible momentum, right? They're turning great sales into actual cash and better profits, and they're doing it all without taking on crazy amounts of debt. They've got a clear, smart strategy for a market that is still, let's be honest, pretty unpredictable. So the big question is, can they keep this fire going? Can they turn this amazing turnaround into true long-term dominance in their market? It's going to be fascinating to see what happens next. Definitely a company to keep your eye on.